Welcome, everyone. I'm Greg Schnell, the Canadian technician, here to host the Market Buzz. This show looks at weekly setups across the U.S. market. Using the tools available on StockCharts, we'll look for long time frame trades. Please subscribe to my articles, my Twitter feed, and to gregschnell.com. Thank you, everybody, for taking the time. Excuse me, all of a sudden the voice goes out. Uh, really nice rally continuing here in the markets. And today I want to talk about one specific asset class in the market. We've got the bond prices are breaking down. And for those that have followed my work over the last couple of months, I think bond prices have been one of the strongest areas where we've been able to kind of identify the final surge in momentum, the retest of that momentum, and then the bond prices starting to break down and bond yields starting to break up. So we're going to go through those charts and talk about what they look like now and what they're shaping up to tell us. So I think that one's important. Bond prices I usually associate with my recession watch, and I've got one chart list that I like to work through, so we're going to go through that. And then I want to start the show briefly by jumping into this. This is interesting. So StockCharts now has the cryptocurrencies right on the homepage, and so we're going to start there. Anyway, with not much time, we will be flying through this, so let's go. So first of all, up here at the top, we have equities, bonds, commodities, crypto. And what we see on the crypto here is this is the Bitcoin chart. And on this Bitcoin chart, intraday here, time going on here, but more importantly, big picture, just so many simple technical tools here. We've got the 200-day moving average swiping through the middle of the chart. And you could just see, right, 50 was support, now 50 is resistance. And now we're struggling here with both moving averages. So anyway, interesting to just kind of close in on this. A real horizontal support and resistance level around 9,000. It looks like it's breaking today. So we'll watch where it closes for the weekend. But I would say on this retest, if it fails here, that could take us quite a bit lower. So anyway, interesting to finally to see these currencies on there, and there's a lot of different ones. So anyway, I'd encourage you to go in and play around with them and see if there's anything you like. But looking at this point and figure chart, it doesn't look that promising for our good friends in the crypto world. Okay, so on the bond charts, what I want to discuss, this one is a chart from LIBOR, and I find this chart somewhat interesting. Ben Bernanke wrote his book, and in it he just said, the 2 year just follows LIBOR, or the LIBOR follows 2 years, what he said. And I look at this and I'm just interested because, of course, the LIBOR isn't bouncing, but the 2 year is. And so to see the two kind of separate like this is quite odd. But we'll just continue to keep watching and see why aren't the bond charts following. This one might be, I'll just go one back here. So this is the big uptrend we had in bond prices, bond yield, and then it rolled over, and now we want to see this start to turn back up again. And you can see this is breaking back out into a big positive run and making higher highs here as we go. So after this big test in late October, all of a sudden everything reverses and goes higher. So we did get our retest, and now the market seems to be ready to go. And look at where it bounced, right, with a momentum right around zero and took off to the upside. I think this is we can zoom in here. Actually, the next few charts probably do that for us. But one of the interesting things is, did I switch? Yeah, sorry about that. This is yield. And I just want to go back to this other chart on here. When we zoom in, let's take this slider and just slide it all the way over. And the point here, you can see that we have been bouncing up against this zero level all the way in here, and now we're going to bounce out of there. And that is obviously a big change in trend that started back in here when we started to bounce off the zero level. So to me, this looks like an early or mid 2016 where we now start bouncing above zero and start to take off. So I'm actually thinking that the bond move is over to the downside for now. I don't know what happens when we get up around the 200-day moving average. We'll worry about that when we get there, but we're clearly trying to turn up here. Okay, so with that, one of the things that we're waiting for now, getting back to that LIBOR chart, let me just go grab that again. This chart hasn't started to reflect that yet. So that's one of the things I want to watch for and see if this can actually start to turn up now. And if we started to get some stability in the interbank borrowing rate, that might tell us that things are getting better. So we'll wait for that. We haven't got that yet. This is the high yield chart. And one of the things that I'm surprised at on the high yield is as the stock market has started to improve, the high yield has not. So we've now made a lower high and higher lows. So we have this low, a higher low, and so far a higher low. But right now we have a high and a lower high. Right around this this 86 level, I'm going to zoom in on this so you can see it a little bit better as well. Just sliding my slider over. And in order to get this slider, you need to have your range on select start and end. But so what you see here is a downtrend in momentum. And again, if risk is rising, so is this. So if people are optimistic, then this should be going up. And the real question would be, you know, we haven't been able to make a higher high, and we've got a series of rising lows. We're coming right to this horizontal support and resistance. What happens here now? And I want to keep watching this chart just to see if the treasury market and the bond market yields and all that kind of stuff, if they all start to fall in line with what the equity market is already doing. And it doesn't have to happen within the weeks of it, but normally it would. Like in 2016, it was January, I think January 25th was the low, and there was a secondary low on February 9th. And that secondary low, this thing took off. So now the question is, why hasn't this taken off? And so we want to keep watching high yield just to see, you know, is there something else going on in the bond market? So the LIBOR hasn't turned yet, but we want to watch high yield as well. So here is the 7 to 10 year Treasury bond ETF. And again, bond ETF, when I use the words ETF, that means it's something you could buy and sell here, not just yield. And what we want to talk about on here is if bond prices are falling, then that makes bond yields rise, just to make that clear. So you can, you know, this is a chart going back to 08, and we had this big uptrend here in bond prices, and now they're starting to fall. And sure enough, our PPO got up to, you know, a really high level here, where normally that's pretty much can mark a significant top in the market. Well, we got up here after taking almost a year and a half and rolled over now, and this to me looks like it's pretty much broken. So even though the price hasn't broken that much, this suggests to me that we're definitely on the move down. Okay, so this is the ratio of high yield to the Treasury and the 7 to 10 year. And what we see here is when this is pushing higher, you know, that's also when the stock market had pretty good years in here. And recently we've been pulling back where high yield has been behaving less strong or less optimistic than the 10 year. And so now what we want to see is this trend should break, and we should start to see this turn up. And I think this arrow was put on here, you know, in late September, pretty much, early October. But this big downtrend in momentum has gone on for 3 years. I think a significant breakthrough here pretty much marks it. And then we'd want to be on the bullish side of yields rising, prices falling in bonds. So that ratio hasn't broken on price or on momentum, but it's very close to doing so. So keep an eye out for that. Those are other things that we'd like to see happen. But again, I think the bond market is already reversing. So price lower, yields higher. But we'd like to see some of these other, I'll call it derivative indicators, start to kick up as well, which would be like a ratio of the high yield to the 7 to 10 year. When we look at LQD, so this is corporate bonds, and this one, last year, roughly almost a year ago now, Paul Tudor Jones said this is the next place for trouble to show up. And that pretty much marked the low. And now it's been riding up. So even the best traders in the world, it was starting to break down here, and he was expecting a little bit of damage. And sure enough, it held. And now it's run up here. I'm sure he'll be all over this market top. He's a pretty good person, pretty good picker of reversals. So anyway, this is starting to break the upsloping trend line. It's now living below the moving average. 10-week moving average in the green is a 40-week. As this starts to roll over here, we'll leave this flag on here. Maybe it takes us a year to get back down there, and we'll see what happens. Maybe the trouble starts to show up now that people start to sell off corporate bonds. Anyway, I think never ignore Paul Tudor Jones. He's a pretty smart trader. Okay, so here's TLT, and on this chart, what we see, we've been looking at this for a while on my subscription service, going through all of my charts on a weekly basis. This one's been highlighted for multiple weeks. And sure enough, this week we finally get the breakdown in the TLT. Now this is unadjusted, which means I've taken out the yield. So we're just looking at the raw price, not the price adjusted for the dividend payment. So what we see here is the price is breaking down. The PPO told us in October 1st that this was going to start to break. And sure enough, this is starting to fail now. So I continue to believe that the bond prices are going to drop. And so the way to play this on the other side of the fence would be to get into TBT. This is starting to move higher, and then it would be this chart going up. Now, this isn't as easy. And the reason for that is because you're fighting the yield. So shorting treasuries is harder work, because as you fight the yield, now the yield payment comes in. So this has to move faster than the yield payment. Probably could, but it's just going to diminish your returns unless you can do it without the yield. Okay, so hopefully I've explained that. In other words, the way to make money in this trade is to go on the other side. I'm not sure that going on the other side makes a lot of money, and the reason for that is because you've got a dividend payment coming out that people are going to get. So and that comes out of your profit. So here's the MYI, Municipal Yield Quality Fund, and I've been using this to help time the 10-year. I've been probably using this chart. It would be interesting to go back and see when I started, but on this chart here, what we see is this has broken. It broke, call it September-ish, and then came back up and bounced into the end of late September and has now started to break down. So this was one of the early clues that this chart was going to break. The momentum had rolled over in July and then again in September here. So this has broken quite significantly. The one question now that we want to see is, what does the full stochastic do? Does it really start to break down? Because if it does start to break down, that actually that can be very positive for the overall equity market as money starts to flow out of muni bonds and stuff like that and go into other, I'll call it, more growth-oriented assets. Okay, here's the 10-year, and what we see on the 10-year is this is starting to try and spike higher. It's making higher highs and higher lows after last month was an inside month. So we've already taken out last month's high and the prior month's high. This reversal is definitely underway. So 10-year yield is rising, and the low price in the bond is falling. So or the price is falling, not the low price is falling, the price is falling. Now, again, one of the big things about the stock markets, and I think this chart just gives us some good reasons to keep looking at it, you just find sentiment get so bearish, and then all of a sudden it's on that bearish sentiment that it looks like things could be changing. So Jamie Dimon said, get ready for 5% here, and then it broke through. Now, that doesn't make him wrong. It just means that you can imagine in a bank full of couple 100,000 employees, that all of a sudden the sentiment is getting one way inside his bank, and it comes all the way down here. And Jamin Dimon said they're getting prepared for negative interest rates, and that was the week after the low. So starting to get these huge sentiment swings pretty important. We do have one trend line that's going to come in pretty much right as we get to the 40-week moving average. We'll be watching to see how price reacts there. And we also have this horizontal support and resistance layer that's gone on for years. How are we going to trade around that? But to me, I think the lows are in. We might stutter step here a little bit to get through some of this resistance, this one, and the trend line coming down. But as we break through, then that wouldn't surprise me that we get to keep going on the bonds. Okay, just quickly, here's the 5-year. And what we see on this 5-year, this is in black. And then I've got the bank KBE ETF. And you can see that all of this downtrend in the 5-year, the banks went sideways, and now the banks are starting to break out as the 5-year breaks out. So not a bad correlation on the chart. What we want to watch for now, obviously, is that the banks keep going and this 5-year yield keeps going. I'm going to just take a look at one more chart here, and that's the 3-month, and then we're going to cut over to a break, and we'll come back, do the 30-year, and then jump into this other stuff. So just give me 1 second. What I want to show you on this 3-month here, as you can see, the chart has rolled over significantly, and this is the yield. So price is rising, and it's been rising since May. But what we want to watch for here is, does this start to reverse and the price start to fall? I don't. It hasn't reversed yet, so that's one of the interesting things. Okay, so we'll cut away for a quick commercial break, and then we'll be right back. And we're back with the 30-year, and this is the bond price. The point I want to make on this particular chart is we have this big, giant trend from 1985 running all the way through the chart. And here we're actually going to come up, and even after the huge surge we had, we're actually going to make a lower high, which is quite interesting, because if you look at this chart, we had one that got very close to the prior high, and then higher, higher, higher. Here we got close to the prior high, higher, didn't get close to the prior high. So this is one of those ones where it surged up in 2010 and then rolled back. But then we made higher high, higher high, higher high, higher high. And now after an extreme move up here, we're not going to make a higher high. So this looks to me, in a very big picture way, long scale of 30 years, that we could be looking at one of the final lows in the 30-year yield and one of the final highs in 30-year price. So really interesting that it's setting up here, and after this big thrust, which pushed the MACD to one of the highest levels ever, pushed the PPO up. We got all the way to 3% change on the 3PO, on the PPO. And looking at that going across the chart, this was a pretty significant level hit, only 5 or 6 times in 30 years. But after getting there, we didn't get anywhere near the prior high in price. So pretty, interesting to see if this is actually going to mark one of the major turning points for mortgage rates and yield and that kind of stuff. There we go. Okay, so here's the 30-year weekly, and what we see on this chart is, so it's the chart that we had up last there with that 30-year channel. This is zoomed in on the last few years from 2011 to 2019. And just like on the 10-year and on the TLT, we're breaking these trend lines. And so having these trend lines break kind of across the 5-year, the 10-year, the 2-year, and the 30-year, all of them are doing that. Now, we haven't seen it again. We're looking for things on the corporate, on the high yield, and on the LIBOR. We want to see what those want to do. Those are the areas that we still want to work. So hopefully I've laid that out, what we're watching for. But one of the big reasons I think we're in for a major trend in long-term mortgage rates from a low and now starting to rise up. This would be a more influential point if we top out here. Okay, let's go over to my recession watch indicators. And the only reason I think it's important to do that is because we're seeing this change in bond market. And so, if the bond market is starting to price in higher interest rates and that kind of stuff, how are we entering a recession or whatever? And what I don't want to give you the answer at the front here, but stay with me quickly. We're going to roll through these charts. So here on the consumer price index, I'm looking to see which way momentum breaks here. And you can see it's been trying to roll over here. It still looks plenty high. Again, you can just see the downtrend in momentum, and it continues to only be around 1%, which is one of the lowest levels basically since the '09 recession. That we don't really get much above it. Anyway, we're sitting right here. So the consumer price index looks flat in terms of momentum. Single family housing starts is still very bullish. If this was to roll over, that would be a concern. You can see that we bounced here on the December low back in 2018, have been rising since in terms of momentum, so nothing there. Housing starts here. We pushed up and made a new higher high, so we pulled back, no big deal. There's a big horizontal support and resistance layer in here that we want to watch for, but it's around 1200. I would say that this momentum has been declining. You can see over here on the right is trying to bounce. So now the question is, as long as this stays up here, that's fine. It's too early to say that this is going to go below zero, but when it goes below zero, that's kind of an area that you want to be watching for that can cause slowdowns in the housing market. Okay. Industrial production. This looked like it was starting to decline quite a bit, and we've all heard about the manufacturing recession all year long. It bounced up here to start August, and then in September pulled back a little bit. So we're still waiting for the October data. But this moving average is one of the things to keep track of. Momentum is already declining and has given us a sell signal, but this chart isn't broken yet, and it could easily bounce off here and continue higher. If I unwind this chart, bit more. What you see here is kind of in 2015, it started to roll over. In 2007, early 2008, it rolled over. I don't know if I have enough data. Just go see. Yeah, and in 2000, it went below the trend line here right about the end of the year. So we're still holding up, but it's one of the things to watch. Anyway, it doesn't look like it's imminent next month, so we're okay. Banking looked like it was going to start to break down, did not. Support held, and off to the moon we went. So the banks still look fine. We'll test prior highs. Airlines, these are just big transportation sort of indexes. Nothing going on here. No data to be had because it just keeps chopping. Autos have actually broken a downtrend going on for 2 years, and they're starting to push higher. Needs to break through horizontal resistance. It recently did that with the big thrust in Tesla. PPO back above zero for the first time since early 2018. That's pretty bullish. Whoops, jumped over the railroads. Railroads had broken an uptrend here, so it had me all on the worried scale. And now it's actually turned and is starting to break this little downtrend in relative strength to the upside. Railroad momentum is back above zero and heading higher after crossing right near zero. That's a pretty bullish place to bounce. It's where it bounced in 2018, and it was off to the races since then. And just looking horizontally on the railroads, this is a common place for it to bounce. And our signal so far for the month is that it's going to bounce higher. So things look good there. Trucking is trying to take out prior highs from 2018, but momentum is clearly improving. So no problems there. Dow Jones World finally broke out above its 18 months of sideways movement and is starting to push higher, and wouldn't take much to get through the 2018 high, and it's above zero and bouncing and turning higher, bullish again. Okay, the 3-month, this was breaking down, hasn't started to turn higher yet, but we want to continue to watch that. This was a recession indicator. When this chart rolls over quite a bit, we want to be worried that, last 2 recessions had that. Some of the ones back in here also. But what we're noticing is so far we haven't had that. So it could be like the 1995 one where it rolls over and market just goes higher. So nothing to focus on there. just going to keep going here. The Nikkei was looking like it was going to start to break down below zero. As a foreign market, it's gone the other way. It's gone ballistic and taken off to the upside, so that's just bullish. For the New York Composite, it's turned higher again. Our PPO is, after declining here towards zero, it started to turn higher, so we're now making higher highs and higher lows. Gotta like that. That's bullish. So that chart has improved. The semiconductors have broken out to a new high. S&P has broken out to a new high. That's bullish. The 10-year to 2-year spread is trying to break this downtrend, and that would be a little bit bearish. It hasn't done it yet, but you can see this move is clearly underway. And with that, the 10-year minus 2-year, this chart here ranging up in this level, if it really starts to go ballistic here, I'm going to talk about that in one of the future shows about what I'd be worried about. The yield curve is normalizing, where the 30-year is here, the 10-year is here, the orange is the 5-year, and we're still a little bit of consolidation around the shorter term interest rates, but as those start to spread out, a normalized yield curve is actually one of the things that we see when a recession might start. So we want to keep an eye on this chart. Doesn't mean one will, but on the big picture, this is kind of the compression we see. And then when things started to expand, this was late 2007, 2008. We're not seeing that yet. So I continue to think that, all the other charts are bullish. So on this chart, we're going to have to wait and watch. The spreads between the 30 and the 10-year, I expected this to go ballistic. It has not. So that suggests to me we're probably still okay. And then waiting for the chart to refresh. Here's the 30-year minus the 3-month, and this has already reached down to those same 2007 levels, 2001 levels, 1990 levels, and it looks like it wants to go north. And so that is one of the charts that worries me. But again, everything else has turned bullish, so let's not worry about it. And this is the 3-month with the 10-year, and it's reversing from a very high level. So to me, it looks like we still have a little bit of time before this market tops out and wants to keep running. Okay, so as we roll through these charts, the broker-dealer index had a big trend line here. I actually had the trend line set up a little higher. I've loosened it off, and now it's turning up. PPO is back above zero on an uptrend. So for now, everything looks bullish. Money supply, looking at momentum down here, it continues to improve. So momentum is up. So all of these things don't show me any sort of recession starting to set in imminently. And here's the unemployment claims. Again, we'd expect this to roll over. It hasn't done that yet. Our momentum was fading here down in the corner. We were actually dropping below the signal line and working our way lower, so a little bit concerning. But you can see that we've been near this zero line for years, and it hasn't broken down. So until we start to see any real damage done, this looks relatively bullish. And so it's close, but it's not there yet. Okay. My final chart is the University of Michigan sentiment, and this chart dipped below the 40-week moving average and pushed back above. So if anything was starting to give us some clue, it was down in here, and it's below zero, hasn't turned back up again yet. But all of these charts as a bundle aren't breaking down enough to cause any sort of recession in the next few months or whatever. So we're going to keep watching the charts, but so far they have not broken down. Thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern, 7:30 a.m. Pacific time on StockCharts TV. You can also catch replays on the StockCharts YouTube channel or on StockCharts TV, which has a running list of technical charting informational shows. And over the next 4 shows, I'm going to have a whole bunch of stuff that talks about technical tools on StockCharts. Thanks, everybody. Bye-bye.